Good afternoon, everyone. Good afternoon, Chairman Sir C.A. Gyanchand Mishra Sir, Vice Chairman C.A. Durgesh Kumar Kabra Sir, today's eminent resource person C.A. Sujal Shah Sir. Welcome to you all for this webinar series on valuation. Today we have it on important topic, which is valuation report and documentation. Whatever we do as a valuer, unless it is documented properly, it is of no point to do valuation. So it is one of the very important topics on which we have to be taken care. And we will start with, now I would welcome C.A. Gyanchand Mishra Sir, who is the chairman of Insolvency and Valuation Standards Board. Welcome to you, sir, for your opening remarks.
Thank you, madam. Thank you, madam. Thank you, Sarika. Very respected Vice Chairman of the Board, C.A. Durgesh Kabra ji. Very learned and distinguished speaker in today's program, Sujal Shah ji, and all respected officers of the Institute, and most importantly, all the respected participants. Good afternoon to one and all. Friends, it gives me immense pleasure to welcome you all in today's webinar, which is on very important topic, that is documentation of the valuation process, which is really, you can say that the blood in the vein in case of reporting of the valuation professionals. Friends, we all know that if there is no valuation, it is treated there is no audit. Likewise, if there is no documentation, there is no document. Likewise, there is no documentation, we can't say that the valuation has been done on the proper background and on the basis of the documents, books of accounts, papers, and other, ancillary support system for the purpose of document, for the purpose of valuation. Today, we are going to discuss this very important topic through our very learned speaker, Sujal Shah ji. And otherwise also, friends, let me tell you, documentation has been crucial part, not only this era. If we go way back in Treta Yuga, when Bhagwan Sri Ram's wife Sita was in Sri Lanka, some documentation was done by Hanuman ji also. When he went there, so one ring was given, by Sri Ram to represent to himself to Sita ji. So documentation has been very integral part to any process of the verification. So verification is an integral part for the purpose of valuation, and that's how we are going to learn it today for the purpose of valuation, how the documentation is very much important. So friends, so many webinars are being organized by the board from time to time for the purpose of updation of the skills and enrichment of the value system of the professionals at large. One announcement that I would like to bring in your notice, that on 12th and 13th of July, the board is organizing the second edition of the Resolve, that is Resolve 2024 in Bharat Mandapam. Last year we had this program in Singapore, and that was a super successful program. More than 350 insolvency and valuation professionals across the globe attended the program, along with judicial members, regulators, advocates, attorneys, valuers, and so many other people attended the same. I request humbly to all the participants who have attended the program to kindly register for the event. This is very wonderful and unique event in its kind, that in which not only we will discuss the various relevant aspects of the insolvency and valuation, but also its future. And so many other, world leaders are going to participate, along with NCLT chairperson, NCLT president, some former chief justice of Supreme Court and High Court, and so the list is very, very long. So friends, we'll request you all to kindly register for this very important event. And I'm sure that today's program is going to be very crucial for the members who are doing the valuation practice or insolvency practice and are looking for the key aspects to learn about the documentation part. So Sarika madam, will request you to kindly give a brief about Resolve 2024 to all the members. Thereafter, proceed with the program.
Sir, can we give the brief afterwards so that all the members will join? Because now process is on for the members to join, sir.
Okay. So please get it briefed in between so that members can understand the same and they can register. So thank you all the respected participants, and I'm very much thankful to Shah sir for his precious time, for the board, and he's available whenever we require his expert views as advices. So thank you very much, sir, to you also, and I'm thankful to Vice Chairman sir also for his joining to this program. Thank you one and all.
Thank you so much, sir, for your guided words. Now I would request Vice Chairman, sir, C.A. Durgesh Kumar Kabra ji for his opening and setting the context also. Welcome to you, sir.
Thank you, Sarika. The Chairman of the IBSB, Insolvency and Valuation Standard Board, C.A. Gyanchand Mishra ji, the faculty for today's webinar, a very learned one and experienced one. I would say that master of the valuation, C.A. Sujal Shah from Mumbai, and all the participants who are here, Sarika, the secretary of the IBSB. Good afternoon to one and all. Friends, the IBSB has organized this webinar for all of you on valuation report and documentations. And I'm sure that the contents which are going to be there and about which our chairman has spoken, how the documentation is important and how one should report it. Our chairman Gyanchand Mishra ji has already spoken on this. I'm sure that the knowledge sharing which is going to happen by Sujal Bhai is going to help each and every one participants who has joined the webinar. As we all know that the Indian economy is experiencing a remarkable growth in various professions, notably in the field of valuation too. The ICI is playing a pivotal role in developing the various standards of the valuations. We are already have developed various standards for financial reportings and transparency into it. Likewise, the IVSB is going to take the lead to develop all the standards which are being accepted by the IBBI also, and we are in dialogue with the IBBI with reference to this. To raise the awareness and equip our members, the various latest development, the IVSB is planning various initiatives which includes the series of webinars, also the conferences, and on the basis of those, this particular webinar is being organized. In this particular series, which is there today on the valuation, the valuation report is going to be discussed. A report prepared by the registered valuer for the purpose of arriving the fair value of the assets under the valuation on the date of reporting for predetermined purpose and scope mutually agreed upon between registered valuer and intended user of the report. And when it is coming from Sujal Bhai, I think it is going to be the fantastic one. It is important to understand for all of us that the valuation report is the first document that a valuer presents to the intended user. And if it is not properly written and drafted, it may not do justice to the immense professional work which has been undertaken by him to complete the assignment. So it is very, very important for all the professionals who are into the valuation. And one must draft it properly. And this is first document. There has to be the another documents to support the valuation. A good business valuation is not only about the determining an accurate and reasonable value, but also about being able to defend it if needed with a clear and concise explanations supporting the conclusion. A detailed and fully reasoned valuation report should be prepared in every case of valuation done in respect of both mandatory and discretionary valuation, where an RV is appointed. And why it is being told that detailed and fully reasoned valuation report has to be there. So I mean to say that even your valuation report has to be properly supported by the various documents and the reasons for which you have, on the basis of which you have done the valuation. The report must contain a clear statement of the value determined, including the valuation date, premise of value, the valuation method which is relied upon, and appropriate weightage placed on each of them. As we delve into the intricacies of the valuation documentations today, let us keep in mind the significance of clarity and accuracy in our reports and supporting material. Further, I would like to again repeat the thing which has already been told by our chairman, Gyan Chandra Mishra ji, with respect to the holding the Resolve 24, which is second edition of the International Conventions on the Insolvency, Resolutions and Valuation. It is there on 12th and 13th of July at Bharat Mandapam in New Delhi. Don't miss it. You are going to meet the leaders of the professions, maybe from regulatory side, maybe from practicing side, and you will have the best time for the networking, how you can increase the work in this area of valuation as well as insolvency. I'm sure that today's deliberation by Sujal Bhai is going to help you like anything in drafting a fantastic and most reliable valuation report, as well as he'll be in a position to tell you that what kind of reasoning and documentation has to be there along with this valuation report which you are giving. Friends, I am confident that this knowledge will take you forward in your professional engagements in time to come, and you will be getting best out of it. With this, thank you all for giving me a patient listening, and over to Sarika for the sessions. Thank you.
Thank you so much, sir, for your kind words. Now I would request to take over. Sujal sir, you may take over now, because it is already 215 members should be benefited by that. This is the mantra of this board also. So a few words about sir. Sir is an independent director on the board of listed and as well as unlisted companies. And sir is a valuer and one of the oldest person who is in valuation or professional who has been doing valuation for 25 years or more. So no other better person can be there other than Sujal Jha sir. So with this, welcome to you, sir. And now you can take over the session.
Sarikaji, thank you so much. Respected Chairman of the Insolvency and Valuation Standard Board, Mishra ji, my dear friend and vice chairman of the board, Durgesh ji, uh, the officials of the institute led by Sarika ji, dear participants, thank you so much for the kind introduction. But let me clarify that I am also still a student of valuation. I am also learning every day something new about this subject, and it's an evolving field still for the country. And it is we are very fortunate that our institute has taken the lead in so many aspects. And as we will share the presentation, we'll see the kind of fast and immediate steps which we took once the Companies Act enacted the registered valuer mechanism as a regulation. Uh, I think it is going to give a great amount of advantage for chartered accountants, because we have a very strong backup from our institute, not only on the technical aspect of valuation, but also on housekeeping aspects of valuation. And I'm really happy that we have chosen this subject, because in real life, I've seen that people do lots of hard work for carrying out the valuation, but that much effort or that much time is not devoted for drafting the report. And as the chairman as well as the vice chairman both insisted and uh, uh, gave us a very clear guidance that ultimately what the reader or the intended user of the entire exercise sees first is our valuation report. And so to that extent, even for the regulatory inquiries, the first thing they look at is the valuation report issued by the valuer. So to that extent, this document, first valuation report, and the entire backup of documents which we keep for our files, and the backup for the workings is it's an extremely important topic. Current changing requirements and current changing expectations from the regulator also will require us to step up our report writing skills as well as the documentation mechanism which we follow in our respective offices. I believe now in the assurance field that has come to a very advanced stage. We have to also speed up as a valuers to reach to that stage, because we'll also have to match with the expectation of the outside world in this regard. So with this very brief introduction, I'll start the topic. Just before I do that, Sarika ji, in the middle, if you want me to take any break for making any announcement, please feel free to interrupt me. I will stop at this stage and then you can do the announcements and then I'll again continue. I will not take a break at any fixed time, but as and when you feel appropriate, you may stop me during the presentation. Now I'll start the screen, share the screen on the presentation front. Once you can confirm me that it is visible, then I'll start. Is this visible?
Yes, sir.
Great. Okay, friends. So how I have covered today's presentation is into couple of. Is this slide? Yeah. Okay. Now, before I straight jump into the topic of documentation and report, I thought if I can give the participants a slight extra background in terms of the entire process, it will be clear to them that why this important topic, is very much required for us to upgrade our skill sets. So slight background I'm going. Otherwise, I could have started straight with reports and documentation, but I thought it will be better for the participants who maybe some of them could be initial stage of the valuation practice. So it may be a better idea to slightly go into the background and how the whole field has evolved. Now, when I started my practice, say around 30 years odd back, and valuation was not a very active field at that point of time, there was no fixed process and it was a monopoly of chartered accountants who were doing the valuation. Now, as we speak today, valuations are not only being carried out by the chartered accountants, we also see other professionals entering in this field. Now, in the registered valuer field, we have merchant, I mean, the MBAs also entering, we have cost accountants, company secretaries. So the field has also expanded. At the same time, professionals who are also doing this work has also expanded. You will see that different practices were being followed by many professionals in ultimately communicating as to what they have done. And that's why there was a need for the whole field to be little more regulated. And that's why this whole process of slowly moving towards a little standardized mechanism of report writing as well as content of the reports were introduced, and we'll see how it got the blessings of the regulators also. Now, how this field has evolved over a period of time. If I look at earlier period to say 1990, the only place where there was a regulatory mechanism of even recognizing a valuation was the wealth tax rules, where registrations were being done by the tax department for carrying out the valuation. Thereafter, there were erstwhile CCI guidelines. That time it was CCI guidelines, controller and capital issues guidelines, which mainly determined the premium at which the shares can be issued in the initial public offers. And of course, today it is not a part of a statutory enactment, but in those days that was one of the most used guidelines, because even for some time, even the FEMA regulations asked the valuers to do the valuation as per the erstwhile CCI guidelines. After 1992 and enactment of SEBI, we have seen so many changes. And first, which we saw in the valuation field was under the FEMA guidelines. Instead of the erstwhile CCI guidelines, they introduced the discounted cash flow method as the method for valuing the shares or any businesses where foreign exchange was involved. Now, you can imagine that time discounted cash flow way back in 2010 was not something which was very regularly being used. So many of the valuation professionals had to do some learning, de-learning to get into the entire mechanism of discounted cash flow method. And I was fortunate that time Institute had the certificate course on valuation, where I had participated in to some extent in designing as well as in the making this subject popular across the country. And that's why I got lots of exposure in dealing with this subject. And I must thank Institute for giving me that opportunity. So to that extent, the methods and other things was discussed in that valuation course in great detail. And many of the valuers, upgraded their knowledge through those kind of very definitive efforts which Institute made. Then came the year 2017, where we had the enactment of under the Companies Act, the valuation registered valuer concept, section 247, and the valuation rules were notified. And I'll come in to slight detail in the subsequent slide that what exactly it has brought into the statute books. 2019, again, we had some FEMA related changes in the FEMA, the valuation related aspects of non-debt instruments, again, where they clarified certain things. In 2020, we also had a concept of Institute of Valuers, which was as a bill. In the bill format, it is available right now. It has not seen the light of the day in terms of enactment, but maybe going forward it may come soon, whereby we will have a separate Institute of Valuers operating in the country. And again, the registration examination may come into the play. Of course, there were regulations. The draft regulations were circulated. There were lots of comments, I believe, from the valuation fraternity, not only in the financial segment, but also non-financial segments, namely land and building, plant and machinery, were circulated and submitted to the government at that point of time. But maybe thereafter it went into a little slow process, but maybe future it may come forward. So these field, friends, have evolved over a period. And in my personal view, we are still evolving. It is not a fully matured field, I would say, as we have it in the assurance practice. And many times this question is being asked that if we want to be in this practice, what are the basic things which we need to learn? In my view, the kind of knowledge which our CA course is giving us is more than sufficient for us to be in this field. Only additional thing which we need to do is to also keep our eyes and ears open in terms of what transactions are being happening in the marketplace, in terms of the various corporate events which are taking place, reading about how the deals have taken place, why a company will acquire another company which is say bigger than its size, some logic and getting into it, creating interest, having lots of dedicated study and reading about this subject will help us to be part of this field. As I mentioned, it is nobody can claim that he or she is an expert on this field, because every day new instruments are coming forward. There are new situations are coming forward. New industries are coming forward. 5 years back, we never thought there will be an industry like AI or something which we'll have to value. All these are newer fields which are getting introduced day after day, and that's why one will have to continuously keep the studies alive for to remaining in this field, and that's why it makes the field very interesting, because it's not a fixed pattern under which you operate. You have to every day think something new. You have to every day apply new methods. You have to every day learn and de-learn certain old methods which we have been trained in the traditional way. So it makes this field very interesting. Coming to the scope of this field, I feel the kind of trigger points for which the valuations are now required has increased so much as compared to, maybe if I compare say just 2 decades back, that we have a huge scope coming forward in terms of the requirement where valuation will be triggered. Now, someone can argue that yes, but as against that, the valuation professionals also have increased. But friends, let me tell you, the chartered accountants have a clear edge over any other professional, with no disrespect to any other profession. But we have a clear edge on this subject because we are taught accounting, we are taught financial management, we are also taught direct as well as indirect taxation, and apart from that, we are also, in terms of other subjects, what we learn, we are also used to writing, various subjects in the essay form. So to that extent, enough knowledge is being imparted through our own course when we take up, valuation. So I don't think so. Other profession takes this subject in that great detail in their examination pattern, and that's why we have this edge. Now, how chartered accountants will have to then upgrade themselves will be through, as I mentioned, through various processes of learning newer aspect very fast, and that's where it as the scope has also increased, the challenges have also increased. Last point before we move to the next slide, I feel even regulators have now become quite active on this field, because with due respect, some of the transactions which took place in the good old days also resulted into some unwarranted or maybe not intentional benefit to the promoter groups, and that's why when any now transactions are being looked by the regulators for approval process, they look it with microscope, because they don't want in future any allegation that minority shareholders were not given their due value. And that's why there's a clear increase in the scrutiny on valuations in the recent times. Wherever a company has failed, the first thing the regulators look at it is that was there a transaction triggered where valuation was being used. So to that extent, we are seeing a very clear increase in the tightening of the regulators, overseeing, or you can say oversight on the valuation as a profession and valuation as a field, and which has helped the valuers also to upgrade and standardize their methods and their deliverables to an extent. And I think going forward, it will definitely further strengthen our requirements. Now, very quickly, just to brief you why I give importance to Section 247 of the Companies Act, because what 247 asks us to do is, wherever there is a valuation of property, stocks, shares, debentures, or securities, or goodwill of assets or other things which are required, where there is a transaction under the Companies Act, it has to be done by a registered valuer. Now, appointment of such registered valuer is by the audit committee if the company has an audit committee. Otherwise, it will be by the board of directors. What is more relevant is what Section 247 subsection 2 asks us to do. First, it says make an impartial, true, and fair valuation of asset. Asset could be business, shares, whatever you are valuing. Second, and most important, is exercise due diligence while performing the function as a valuer. Then valuation has to be made in accordance with the rules as prescribed. And of course, certain, if you have any conflict about certain dealings in the company in the past, it prohibits you to do. What is more important in this entire thing is second aspect, exercise due diligence. Now, how do you demonstrate that you have been diligent while doing a valuation? What will drive that will be the documentation and the supporting, and ultimately the report what you write on the valuation. So for us to demonstrate that we have done a few impartial and true and fair valuation, as well as we have been very diligent to doing exercise, what will help us to demonstrate is the subject matter of today's seminar or the conference. So that's why I give more importance to documentation and report, because now this has got the trigger point from the Companies Act itself. Subsection 2 of Section 247 itself wants us to be, not that it was not there earlier, but now it has been brought into the Act in a very specific manner. Then that's why it has got extremely high importance in the current times. Now let's slightly go back to the entire mechanism under which this registration of valuer works. So first we have a body which is IBBI, which monitors the entire registration and it monitors the whole profession. Below that IBBI, we have registered valuer organizations, and there we have thereafter every RVOs will have a registered valuer under its fold. So just to give you an example, our ICI RVO will have its own registered valuers registered with itself. There are other RVOs who will register their own members or even non-members also, subject to certain fulfillment of conditions. So just to give you a flavor, today, as we speak on 12th of June, we have 15 RVOs registered by IBBI, 15, 1-5. We have around 110 registered valuer entities who are registered with IBBI. In totality, for all the classes of assets, which includes securities and financial assets, which also includes the land and building and plant and machinery, entire registration process, we have about 5,566 registered valuers, and out of 202 are registered for securities and financial assets, which is the more frequently practiced by chartered accountants. Securities and financial assets. Now, this will include your shares, your businesses, intangible assets, all put together will fall into that basket of securities and financial assets. Land and building and plant and machinery are different other categories, where it is not generally the chartered accountants who will be able to do those valuation because of certain restrictions and because of the education background which is required to carry out those valuation, which typically a chartered accountant may not have. So these are the broad mechanism under which it works. The disciplinary other mechanisms are now well defined, how the disciplinary cases will be handled, and that's why now it has got an extremely high focus, because just imagine now, even if there's even a likely case of disciplinary inquiry, you have people who are knowing this subject also dealing with the disciplinary entire process, so that in a way it also is good for the professional who wants to explain his point of view. The other side of the table will have a better receptiveness, because the subject is something which is now under highly concentrated effort of being monitored and regulated. So now what is the how this entire thing about valuation standard came into the force, and why valuation standards institute was the first one to introduce and which adopt those valuation standards. So what was one of the requirement is RV, that is the registered valuer shall, while conducting the valuation, comply with valuation standards notified or modified by central government. This was the requirement. Until such thing which is notified, a valuer shall make valuation as per internationally accepted valuation standards. We have many internationally accepted valuation standards in place, or valuation standards adopted by the RVO. ICI RVO has already adopted the valuation standards issued and notified by ICI, our parent body. So to that extent, our valuation standards have already been adopted, and that's why those who are registered with ICI RVO will have to follow the mechanism or the guidance given in those valuation standards. And friends, I remember 2018, the kind of hard work which had gone behind bringing out this ICI valuation standard was, something which is remarkable, because at the speed at which our institute worked and introduced these valuation standards, it was something which was unparalleled. And before any other institute could work on it, we really put in lots of hard work to bring those valuation standard, and it really helped us, because those standards have now become more or less the norm. And as I heard Durgesh ji, if we are fortunate enough, it will be also approved by the regulatory bodies. So we'll be waiting for that. Now, valuation standards which were introduced and adopted by CA Institute in 2018, very broadly, which are those? What are the reasons why these valuation standards were introduced? First, the approach and the requirement was that how do we bring uniformity in approach, and how do you insist as well as make sure that there is a quality of valuation output, because valuation standard, like accounting standard, also will guide the valuer as to what are the requirements the standards will prescribe and whether they are being followed or not. Now, as per the requirement, we have to actually make a positive or negative statement whether we have followed the valuation standards, and if yes, which are the valuation standards we have used in our final report which we issue. So to that extent, we have to make a affirmative statement or a statement to that extent, which standard and which are the standards we have used for carrying out the valuation. And as I mentioned, 1st July 2018 was the trigger point on which from which the valuation standards were made effective by CA Institute and adopted by the RVO. Now, which are those standards? Without getting into, it's not a topic where today we are discussing the standards, but just to give a flavor to the participant that these are the standards which are there on the screen, which are being already notified. And as I heard the chairman and the vice chairman said that we are also in the process of further introducing new standards on other subjects and other asset class also. So that also will give us an additional advantage in terms of this. But those who want to be in this practice, my sincere request will be to go through these standards. Wherever there are doubt, Institute has come out with lots of guidance on these standards also. And the whole RVO, the kind of efforts which are done for supporting a valuer, I think are unremarkable. We also, give a lot of technical topics related, publications are coming. So I think enough material is served to the professional who want to be in valuation field. It is now our duty as a professional to grasp all of that. Wherever there are doubts, there is already a guidance available. Somebody, you can check with some people. There are professionals who are available who will guide you. But do not shy away to get into this field. And the reason I am saying is that I have seen lots of resistance when it comes to valuation from our professional brothers and sisters to accept this kind of assignments. The first reaction is that we have never done valuation and it is not something which we learn, understand. Let it be done by somebody who knows this subject. But friends, as I mentioned, our basic study which we have done for our course, plus the additional dedicated effort if you will make, and application of certain common sense, I don't think so this subject is at all difficult for anybody into this field. When I entered this field, I had no formal training. What I have learned from is from various assignments which I was fortunate to get being part of. And that's how over a period it has come into the place. It is not has happened overnight in terms of just somebody going through a course and giving you that kind of knowledge. It's a entire process which we have to go through. So likewise, unless you make a beginning, you will not be able to be in this subject. So first and foremost, who have not passed the exams or registered valuer, my suggestion will be to become registered valuer and then go through the process of further sharpening your knowledge on this subject. So let's very quickly go through some of the very basic parts of the valuation, because once you understand this, you will be able to appreciate what kind of changes you will have to bring to the report. And why I am giving importance to this aspect, because many times I have seen people, in fact, many seminars where I have addressed, I'm told that kindly share the draft report, which we can use. But my sincere request to every participant will be, instead of using an old existing draft, try to draft your own valuation report, because each case is a different case. Each situation is a different situation. A particular language used in an earlier report drafted by your firm or somebody else may not be suitable to you. And I'll tell you, while going through some of the reports, many times I come across certain wordings which are used which are not at all applicable to the company. For example, in some reports, they'll write that we have valued the surplus assets situated at so and so in using so and so's report. Now, if you go into the reality, many times it happens that it was there in some earlier report, and person who's signed a later report has never bothered to check the language, and it has gone the same way. Although the company you are valuing now has no surplus assets. So cut and paste, yes, definitely it helps to save our time, but many times it is stopping us to think and write. And as you will appreciate that ultimately, if a regulator scrutiny comes to your report, you will be asked to stand up in front of the regulator and explain your report. And if anything like this is found in a report where it is not relevant, or it is wrong, or it is something which is not properly represented, the first impression the regulator will get is that this person has not done a right job. So many times we get into this trap of saving the time, but without realizing that after few years, when my report could be opened for any regulatory scrutiny, I may not be able to sustain the kind of inquiry which will come on me. So my humble request to all the participants will be, not, you may use a template, but don't use complete, cut and paste in any valuation report, because it will always help you to, redraft the sentences in a way which you would like to, present to the reader, rather than somebody else who may have done before a particular, passage of time. Now, coming to this subject, now valuation, is an art. It is not an exact science. So one fundamental thing which I see missing in many reports, that please understand, here we are expressing our opinion. So when you conclude in any valuation, generally the valuer will write, in my opinion, or in our opinion, if it's a registered valuer entity who is issuing a report, that in my opinion or our opinion, the fair value of this asset, which could be shares or a business or an intangible asset, is so and so. It is generally not. In many reports, you have seen the wordings like, we hereby certify that the fair value of this company is so and so. That those kind of wording here, it is not a net worth certificate. Here you are expressing an opinion. And that's why if you see on the left side of your screen, why I have written it's a subjective thing. Because if there is a contingent liability in a company, I may, as a valuer, take it in a particular fashion, say 50% of the amount as a impact of contingent liability. Some other valuer may take only 25% or 75%, because every valuer will perceive this particular contingent liability in a different way. More so, many times, discount rate, what we use for, say, discount rate cash flow method, it is ultimately an opinion of the valuer. So if a particular valuer perceives a higher risk to the cash flows, he may apply a higher discount rate. Same projection, some other valuer may use a little lower discount rate, because if he or she feels that the risk attached to those cash flows are lower. So it is not something which is like a proper formula by formula, but there is an element of subjectiveness goes into the valuation. That's why many times I say this, that whenever a company's valuation is being done by two valuers, same data is shared with two valuers, generally it is not the case where you will come out with the same conclusion. Yeah, you may be falling in the same range, but generally it is not very often seen that exact number will also come the same, unless it is something like a, based on a net asset method or something where there is no major adjustment which is required to the valuation, and no usage of subjectivity is warranted. So otherwise, in most cases, you will find that the valuation may differ from one individual to another individual. And somebody may ask then how the regulators will look at it. Now, regulators are also clear that it is not something where we will be able to, always look at the same number. So regulators are also aware that there is a subjectivity involved. Now, however, I should not, as a valuer, use that subjectivity argument to adjust the value to achieve a particular target value. Whatever logic I use, whatever factors I use for any calculation where subjectivity is involved, has to have a proper documentation and reasoning. So, for example, if I have used 50% probability for a contingent liability, I must have a file note in place whereby I write a remark that why I have captured 50% and not any other percentage. Somebody who is using 25% may feel that this contingent liability is there, but it may not fructify, and that's why he may ascribe a lower probability to that contingent liability. But he must write in his file a reason, note that why he feels or he or she feels 25% is a ideal probability to apply for in his opinion. Again, friends, as long as you have such reasoning which is logical and which has a proper backup, I don't think so regulators will hold you responsible for arriving at a two different valuation, by two different professions. But if you have no reasoning, and this is many times when we come to some other slides, I will explain you that many times we have to give weightage to the different methods. Many times these questions are asked by regulators that why you have given 40% weightage to say discounted cash flow method. Now, if the valuer is able to stand up and say that yes, I have been able to justify it because these are the reasons why I feel 40% weight for this method is ideal, and if there is some backup some old past legal cases, then the regulators will also understand that yes, why this person has used this particular weightage. However, if the weightages are maneuvered in a way to ultimately arrive at a particular number without any logic or reasoning, you may find it difficult to justify, and that's where somebody can be in trouble. So, suggestion out of this entire discussion is that wherever you have taken a subjective call, ideal situation will be to keep a file note, because one another thing which bothers many times valuation professionals is that the inquiry may come after say 4 years, and the person who has carried out the valuation may not be in the firm. He may not be available at that point of time. In that case, the file should be a speaking file where the documentation and the reasoning are well, preserved. And whenever required, it is presented in a way that it can serve the purpose. Because many times these professionals keep changing the form, so you may not have the benefit of having that professionals with you, so or who has helped you to do the assignment. So that aspect also one needs to keep in mind. Last point is that valuation is a date specific thing. When I say date specific, and I always give this example in many seminars on valuation, that suppose I had done a valuation of say Taj Hotel in Mumbai on say 1st of November 2008, and if I was attempting the same valuation on say 1st of December 2008, whether my conclusion would have been same? Answer could be no, because between the two dates an event took place. There was an attack on the hotel. There were so many people who lost their lives. Nobody knew what kind of refurbishing costs that entire property will have to incur to bring back the old glory. And also nobody knew what kind of compensation, apart from the insurance and other things, which they will have to pay to the people who lost their lives or who got injured. All these were so sort of fragile at that point of time that nobody could come to a same conclusion between just a 30 days time period. The entire valuation of the property could have changed. So that's why it's a very date specific. I always call that valuation is a perishable product. You cannot use the valuation given 6 months before and say that okay, this is my valuation, I've got this 100 crore valuation for my business and it will hold true today also. It could have increased, it could also have gone down depending on the underlying situation, underlying economic conditions, underlying changes in the regulatory laws pertaining to that industry. So there could be many factors which can change the valuation from one date to another date. And that's why generally you will always see that whenever transaction takes place, the valuation report is taken as near the date of the transaction as much possible. In fact, Rule 11U under the Income Tax Act says that whenever unquoted shares are transferred, the valuation or Rule 11U calculation is generally insisted on the date of transaction. However, it throws up a lot of practical difficulties, but I'm just saying that is the way, they give the importance of, date in the valuation. And when I come to documentation, I'll tell you how many of the reports which went through the scrutiny of peer review mechanism of the RVO, where there were flaws which were found. And that's a report which RVO itself has published. So you will be able to appreciate that lots of efforts are being made to make sure that we all as a professional come to the level of expectation of the profession which it requires. Now I think I have covered this slide whereby different classes of valuation are being done. You can also in the last slide, box, you have jewelry valuation, some drawings, paintings. All these are also different classes of valuation, and we have professionals now who also do a specific valuation of those classes also. Our main, I would feel that when it comes to chartered accountants and those who are registered under SFA, which is securities and financial assets, we generally come under the first three baskets, whereby we value the shares and other assets, financial assets, which could include any other financial instrument also. We also do business valuation and intangible asset. These are the three domain of chartered accountants. Apart from this, other professionals who are engineers will carry out the land and building or plant and machinery valuation. So those who are registered under SFA will generally pick up the first three boxes. Now, why this slide is important to understand that why the valuation is triggered. Purpose of valuation, because your entire deliverable, entire documentation, what you preserve, will be guided by the ultimate purpose for which you are being appointed. So if I'm writing a report for, say, FEMA, my entire language has to cover the requirements of the FEMA regulation. If I'm using a report for any income tax, and particularly say Rule 11 UA, the whole report writing has to be in line with what is required under the tax regulations. If I'm issuing a report for any SEBI related approvals, again there are certain circulars which are issued by SEBI which requires you to do the valuation using certain guidelines or certain reporting requirements, and I've covered this in one of the slides which will come through. So each requirement will ask you to do a valuation using methods which are prescribed under that regulation. And not only that, the entire documentation and the report format also will be guided by these trigger points, as I say, for valuation. Trigger points, why we say, because you may be called to do the valuation for litigation within the family. It could be for fundraising for an IPO. It could be for a corporate restructuring, which may involve mergers, demergers, or subsidiarizations. So depending on the purpose or the asset which you are valuing, say there is a third column which is for intangibles. You may want to purchase or sell an intangible, say a brand, say customer contacts, or human resources. That will require a completely different methodology. It will require a completely different approach, and finally the documentation. You may want to use the report, you may be called upon to do the valuation of an intangible for hypothecation. The owner of the intangible wants to hypothecate this asset to a banker to get a loan. Now, again, your report writing has to cover these aspects. We also do, as a valuer, we are also many times asked to do the fair valuation or impairment testing under accounting standards. Now, again, there are certain principles which are prescribed on those standards. So we have to work into the four boundary walls which are defined on those accounting standards, and that's why you will have to write that in the report, because many a times, as you may be aware, that whenever you do a valuation for Ind AS, and there is an auditor who will review this, he would like to see whether you have covered all the relevant aspects while carrying out the valuation, because based on your report, he is giving an audit report, which is either a qualified report or a clean report. So to that extent, the deliverable or the final documentation or the report which you will write for Ind AS could be completely different as compared to what you will do for a merger valuation or for a valuation under Income Tax Act. So that's where this slide I thought is important for us to get into this field of knowing first of all which are the trigger points. In fact, this may also open up your thought process about which are the different trigger points on valuations which are being now under which we are approached as a valuer. So you will see that kind of requirement now which has increased. Again, if I go back to the history, in good old days, you were called upon to do the valuation, say for mergers, or many times, we were just called upon to guide the management about what's the fair value for the business if he's either buying or selling the business. But now you just see kind of regulatory requirements for valuation also, which has got introduced. FEMA, Income Tax, SEBI, Companies Act, Ind AS. You see so many trigger points which have come up, and that's why I see that the scope of this field is very high, because apart from these trigger points, there are also non-regulatory trigger points for valuation, which could be for say family settlement, or it could be for just guiding somebody to start his negotiation for purchase or sale of assets. It could be just a more like a consulting rather than even a report based requirement. So we have so many trigger points which helps us now to capture this entire field and understand and learn this entire subject in a way where we can complete the whole cycle. Now again, before getting into the documentation, I thought it may be very relevant for us to understand how this entire process works, valuation, because some of you may not have actively done a valuation assignment. So I thought it may be relevant. For some, it could be a repetition. So please bear with me. So first and foremost, as I mentioned, when you are called upon to do a valuation, you must understand what is the purpose of doing this valuation. And as we understood from the earlier slide, unless we get into the purpose of the valuation, we will sometimes may fall into this trap of doing so much of work which may not be even required, or may require from a very different perspective. So I would suggest you to understand the purpose first. So whenever you get a call on the phone, many times people say that okay, this valuation has to be done in, and how many days you will do. Unless you know the purpose and the whole complexities involved, please avoid answering on the phones. I have done this mistake in the past, and I have fallen in the trap. Not, I would say, intentional trap, but just some known person will call and say, I need a valuation. Many times, without understanding the complexities involved, we commit to a timeline which may not be possible. So please first ask for the financials. Suppose you are asked to do a valuation of shares, you please ask for the financials, because unless you read the financials, you will not know the complexities. So the time required for us to carry out the valuation will be determined based on the complexities and within your own organization availability of the relevant team members. So it is possible that you may be able to turn around in a shorter time, but for that you need to be fully prepared as a from a data perspective, and also you need to have a required team members also ready. So after that only you will be able to assess. So information, once you go through the the entire engagement letter process, you have to seek for the information. Generally, it you also end up sending the information requirement list along with the draft engagement letter only, because companies will at least know what kind of preparation they have to make when they want to get this valuation done. This question has been asked in many seminars to me, that many times we get a requirement for doing valuation, say in a day or two, whether we should take up the assignment or not. Now, answer lies within yourself only, friends. That if you are confident that the data will be supplied on time, and you have enough trained team members who are available to turn around in that short time, then only take up such things. Tomorrow, if such valuations are challenged, and you will not be able to use an argument to the regulators that I was given only 2 days, boss, how can I do, more work? Those arguments will not help us. So that's why you have to assess your own capabilities. When I say capabilities, physical capabilities of team members, office environment, data availability, all this, needs to be assessed, and then you commit to a timeline. Another very common problem which I also receive lots of questions at various seminars is on the that many times a target is given that we need this valuation because commercially we have closed this transaction at this particular time. Now, okay, you may hear that out, but beyond that, ultimately you will have to process the data and see what range you are coming out. Just to give you an example, suppose you are told that commercially we have closed at 100, but now we need a report for a regulatory approvals. If based on your calculation you are coming to 98 or 102, you will be able to converge somewhere because the gap is not very high. But suppose your number comes to only 20 and the transaction is happened for whatever reason at 100, I think you will have to step back and say, thank you very much, but we are not able to, sort of even come to that anywhere near. Because again, they may have concluded based on certain underlying things which we may not know also. We don't need to know also. But at least we have to make a very independent assessment ourselves that whether we will be able to stand up to these calculations when even if it is challenged. So I always tell and guide people that you assume that whatever valuation you are signing, you assume that it is going for a regulatory inquiry. So your preparedness, your thinking process, everything will fall in place that, what kind of preparedness I have to make for completing this assignment. I don't want to sound negative, but at least I want to make sure that we don't take things for granted when it comes to regulatory framework. Now, with due respect, now we have to, come to that mind frame that, if it is challenged, how I'll defend that valuation, and that's where it may require some extra time, it may require some extra resources at your end, it may require some extra upgradation to the skill level. So either of these or all of this we need to continuously attend to ultimately go into the desired level of quality. I would not get into the details of the data once it is received, how it is analyzed and other things. Only one point I would like to sort of stress upon is a discussion with the management. Now, friends, what happens many times we discuss this, say projections are given to you, and now under the very clear guidelines, we have to also scrutinize or we have to go through the assumptions which are given in those projections and at least satisfy that broadly they look to be in order. And just to give you a flavor, suppose your raw material consumption in last 3 years average was 55% of the turnover. Now, suddenly when you look at the projections, if they have assumed 40%, 42%, 39% for the future years, you will need to get into the details why they've assumed those lower projects. Is it just to achieve a higher valuation, or there is an underlying basis of going for that lower raw material consumption based on some contract being signed by the company for a cheaper raw material or new source of raw material which is found, which is not affecting the quality, but the cost wise it is saving your 20%, 30% cost. unless you get into that detail, you will not be able to pass those projections. And that's why discussion with the management is going to be very critical. Now, many times in the current times, because of the advancement of the technologies, in good old days, we used to go to the company, make inquiries, look at the physical facilities, everything. The entire process was a long process. Now with technology, people will just come online and give you some explanation in pieces and bits and pieces. Now, as a valuer, you will not be able to remember that in those 10 or 12 calls which you had, what kind of explanations were given. So my suggestion for that will be, whenever you get an explanation for the management, you note it down with the time and date that on 15th June he had mentioned to me that this is the reason. On 18th June call, he had mentioned this. And generally what we do in the management representation letter, we get it signed, we summarize all those points and get a confirmation from the management. Because an oral explanation given is fine, but after 3 years, 4 years, First of all, you will forget that what oral explanation was given. And secondly, the regulator will not listen to you that, okay, CFO at that time had mentioned to you this much, because you have no documentation in place. That's where what is required is that you have a series of discussions with the management. You note down all the points and put it as a part of your management representation letter. I would suggest all relevant points. There could be some clarificatory points which may be given, some explanation to an assumption given, which is not very important or very material. You may not write everything, but at least all the big points, say 7, 8, 9, 10 big points which are affecting the valuation materially, you must keep those summary of the points and then get it added in the representation letter, which will help you in future days if in an unforeseen circumstances of it going for any regulatory inquiry. Another point which I have, sometimes noticed that we have a tendency to only discuss with financial, say CFO or, people who are from finance or accounts or treasury departments. And that's a natural process because we are ourselves chartered accountants. So our first target, the connect point is CFO. But when we come to the valuation of any business or shares, it is also equally important for you to learn the business and or understand the business. And that's why discussion with the CEO or the managing director, discussion with the technical head of the company, because what kind of machinery you are using, how old is this machinery, when it will require a refurbishment, all those technical chief of the company only will be able to tell you. Apart from that, for the sale price of your products, the person who is in charge of marketing or selling will be able to give you that clarification that yes, these are my assumption because of this reason. Say a new player is coming into the field, and there are chances that your sale price will have to be brought down because new player will come with a better technology with a lower cost, so he will sell the product at a much lower rate as compared to your today's selling price because you are using the old technology. Now, whether it will affect my future production, whether quality is impacted because of this, all these aspects you will be able to know only if you are able to discuss this with a non-financial, executives of the company. If you have a liberty of time, I would also suggest that you must visit the facility of the company, because unless you understand what goes into the machine and what comes out as a final product, many times you will not be able to take a call about where is the raw material coming from. Is it imported? If it is imported and locally consumed, am I exposed to the foreign currency risk? Am I exposed to the price increase? Am I exposed to some regulatory restrictions which may come in for import of such material? All these are different questions you will understand only when you see the facility. I fully appreciate concern of the valuers that we are not having liberty of such timelines, and many times there is a resistance from the client itself that why you want to visit the facility. But if you feel it is a material item, at times you may have to spend the money from your own pocket if you want to satisfy. If client is not willing to take up that cost, fine, but at least for your satisfaction you may do it, so that you know exactly what are the exposure points this company will have if I'm using a particular material. What are the chances of that disruptions which may come in, or is there an opportunity lying because I am having a better raw material source. All this you will know only when you see with your own eyes that where this what is being put into the machine and what it comes out. I'm making it slightly simpler, but it's not, the industries are not that simpler. And many times, yes, from the internet you will be able to understand the process. Say for example, I'm valuing a cement company. Now how the limestones are extracted and how finally the cement it is put into the final packed bags, unless I understand and know the entire processes and where all there could be hiccups. Now, every such plant requires a 1 month of shutdown every year, say for example. Now, there is not only the 1 month of loss of production, there is also cost involved to that. Now, all these discussions will come through only when you see the plant and you ask relevant questions to the executives. So that is one important thing which I thought in the analysis part I would cover. Then methodologies is our valuation skills. And finally, assigning the weightage, what recommendation you give and what you write in the report is the most important thing, as we have now discussed enough that why this is so much important. Now, slightly, I'll spend 1 or 2 minutes on the weightages which we use. Now, friends, why do we use different methods? Because, we have asset approach, we have market approach, we have income approach. There are 3 different approaches, and within those approaches, we have multiple methods. Say, for example, it's a market approach. You have market price method, you have enterprise value to EBITDA multiple method, you have P multiple method, which is our old good old method, which we were using in before the EBITDA multiple method came into the place or being frequently used. So all these are, or say transaction multiple method, all these are different multiple based method. All will fall into the market approach. Now within market approach, are you using 2 methods, 3 methods, 1 method? Why you discarded other methods? These are the points which will be have to be kept. Now having used say 3 methods, say asset approach, I've used 1 method. I've used market approach 1 method, and I've used income approach, which is the discounted cash flow method. Now, what weights do I give? 1/3, 1/3? Do I give higher weightage to DCF? Do I give higher weightage to market approach? And why I have, assigned a particular weightage is reasoning of that will be very critical. Now, just to give you an example, if the plant is going for a future expansion, it's already sitting in CWIP stage, and next year or year after that, you will be having a doubling of your capacity. In that case, your past results based on which you apply EBITDA multiple may not be a very appropriate method. It may not be completely wrong method, but you may not want to use it alone. So you may give a little lower weightage as compared to income approach. Now, again, these are some of the clue points I'm giving. Please don't use it as a fundamental rule that this is how we have to do. You have to apply your own mind. And why I used somewhere before in my discussion that we have to use our own common sense also. Whatever reasoning you write or whatever reasoning you come out with, you have to have a logical conclusion also for that. It has to have a logical reasoning. That's where many times, assigning weightages is used to ultimately arrive at a particular number. We should not use weightages to just come to a number. Our weightages should be based on certain logical, solid reasons why we have given assigned a particular reason. See, a particular manufacturing company, I may give just 20% weightage to the asset method because assets are important, but at the same time, it is not a liquidation stage. Or many times for say NBFCs, asset base is become extremely important. My price to book value method is the most appropriate method, the starting point of which is the asset value. I mean the book value of the company. So in that case, it can carry the highest weightage. But if I'm going to a value, say Infosys or TCS, where asset base is of no importance, I may give a 0% weightage to asset method and give a higher weightage to market or income approach, or equally between the two of them. The point I'm driving is that you must have the logical reason and why you feel that a particular weightage is what you have ascribed is something which is very suitable for the exercise you have taken up. Nowadays in the SEBI, you have to also give the report, in the report, the weightages which you have given. So many times I have seen when two valuers have done the same valuation, their weightages are different and both of them have given their own reasoning just below the table. I'll come to the table in a short while. But so again, not that those mergers are not approved by SEBI or stock exchanges. They are approved because they were convinced with the reasoning given by the valuers. So it's not necessary the two valuers will give the same weightages. But yes, as I mentioned, whatever weightages you give, keep a reasoning, keep a logical file note, and then you will be able to sustain that stand what you have taken for that particular exercise. Now let's come to some of the finer aspects of the documentation which we may require and why this is sort of very high importance in the current times. Valuation report, standardization, it has come now into the place because what it wants is minimum content of the valuation report. And every time I give this example that when I started my career, there was a much celebrated case of merger valuation where two valuers had done the valuation. One valuation report was just a single page and another was set 12 pages. Now, not that both were right or both were wrong. The point was There was no standardization. The both felt a particular way of writing, and they one wrote in a great detail, another wrote in a little condensed form, and just finished that report in a 1 or maybe 1.5 page. But not that that makes the report wrong. That time there was no valuation standard, there were no valuation rules. So this was all okay. But now in the current times, we need to follow certain basic content requirement which are given in the valuation standards as well as the rules. How you have prepared your valuation is gives, and how the maintaining the sufficient documents for the appropriate. Now, friends, one aspect which I'm sure you are aware, that like peer reviews being done by the audit fraternity, assurance fraternity for their firms, which is now a requirement for many years. Even for valuation now, there is a peer review mechanism which is there, and valuation reports are being peer reviewed. Maybe time is not far that how the assurance practice the valuer, we have a peer reviewer coming to our own site and doing a file review. We may have that also, which may get triggered very soon. So it carries a very high importance for all of us to even reach to that level where any peer review is being done. You must pass this test with good marks, if not full marks, so that at least the regulator will get that confirmation that yes, the valuation fraternity now has upgraded themselves to a desired value documentation requirement. Now, form and content of valuation report will depend on the nature of engagement, which I have discussed at length some time back, and what is the purpose for which valuation is being triggered. A valuer shall document matters which are important in providing evidence that the valuation assignment was carried out in accordance with ICAI valuation standards and support his assessment with the reported submitted by. Now, friends, what happens? Many times, as I mentioned, there is no clear format under which you need to maintain your file notes. What I generally, prefer that wherever you have your valuation workings, you keep a reference point. That either some adjustment which you have done in your valuation workings, either it will flow from the annual report, it may flow from the projections, it may flow from a management representation letter, or from any other publicly available source and from where you have used this data. So for example, market price method, you may have used say BSC or NSC data. So write the source that I have used NSC, so keep the relevant prints if you want to keep paper support of the documentation. Nowadays, of course, most of the people have moved to softer copies, but again, safeguarding of those softer copies and backup of those softer copies we have to ensure. But so I was coming to the format of documentation. So that could be your starting point of which are the documents I need to follow. So suppose you have applied EBITDA, EV/EBITDA multiple of 8 for a particular case. Now, how that 8 has come, I'm sure in the valuation workings, you have done enough of groundwork. So many comparable companies you have taken, you have discarded some comparable companies, you have given higher weightage to some comparable companies which are very relevant for your exercise. All this will come out from your workings, and once you keep those workings and the notes thereon, that why you have discarded a company which say I'm valuing a cement company, and I have discarded say Ambuja Cement for some reason. It was not comparable, it was size wise, it was large, whatever. I must write a note that although Ambuja Cement is in the cement industry, I have discarded it. Either it was too big in the size or it was not relevant. It was operating in a geography which was not relevant, whatever. I'm just giving you a clue that at least then tomorrow, if a regulator will ask you that there were, according to them, there were 15 companies which were comparable. You have taken only 10. At least you have a ready reason that why those five companies which you have discarded or which you have not used for the arriving at the multiple, what are the reasons for? So it will help you to also stand the scrutiny of any regulator. Okay, valuation report to be prepared with due professional care. I don't think so for this August body I need to elaborate this line. Now, valuer shall minimum include the following in the valuation report. Again, these are coming from the rules. So background information of the asset being valued. Now, what do you mean by this? Suppose you are valuing shares. Which are the shares you are valuing? Equity, preference shares, any other financial instrument? what are the basic terms of those shares? Are they carrying differential voting rights, normal rights? If it is a preferential shares, are they having a convertible clause attached to it, or it's only redeemable? Anything which you feel are relevant, you must include in the background information. Second, why somebody has engaged you to do this valuation? What is the purpose? So is it for hypothecation? Is it for sale? Is it for a merger? Is it for a demerger? Depending on the requirement, you may guide the reader that this is the purpose for which I am appointed. Because why it is relevant? It is possible that you may have carried out a merger valuation of two companies. Say again, just to very broadly give an example without any, say ACC and Ambuja, you have just given a merger report. That does not mean individual value of those companies are going to be relevant, because you have done a relative valuation of the two companies under merger. So the point is that unless you write the purpose, tomorrow somebody should not pick up a single number from that report and use it for some other purpose. Say a banker should not use a merger report for financing a company, saying that in merger report this share was valued at 15 rupees a share. So that's where purpose is very clear. And when you conclude also, when you finally write your conclusion, you please write that in keeping in mind the purpose mentioned in para number 2 point so and so, the fair value of the company in our opinion or my opinion is so and so. So the reader will know that this is in context of the purpose which you have defined earlier. Identity of the valuer and any other experts involved in the valuation. Now, you have to also mention that so and so firm has carried out the valuation. This is the broad background of the pack. So generally nowadays you will find the valuers have started writing a para about the entity which is doing the valuation. Why? Because the reader must know what is the background of this entity, and that's why it has now become a very relevant aspect in the valuation format, that you must write what background or of the people who are involved in the valuation exercise. Now, second point in that bullet is that if are there any other experts involved in the valuation? What do you mean by other experts? Now, say for example, if I'm valuing a company and it has a surplus land of say 100 acres in just outskirts of Mumbai. Now, as a financial valuer, I don't know whether that 100 acres is worth 100 crores, 500 crores, or 1000 crores. We don't know the underlying market value or the fair value of that particular asset which it is holding. And since it is not my subject, generally, as a valuer, we will insist that please get it valued by another registered valuer, and either you will attach that valuation report along with your report as an annexure, or you will mention that valuation report of Mr. So-and-so or Messrs. So-and-so, dated so-and-so, pertaining to 100 acres of land which is surplus in nature, so that the reader will know that for that asset, you have used a report of some other expert in that particular field. Now, many times the question is being asked that if you use some other expert's report, do you carry as a main valuer any responsibility? And I believe in the rules, there is an expectation from the main valuer that although you may have used other valuer, you have to make a broad inquiry that the assumptions and the conclusion that expert has arrived at, is it within the range, fair range, which is being prevailing in that particular area. So if somebody has valued a land at say 100 crores, whether in that area, is that something which is a prevailing rate, or are there transactions? So some broad inquiry we have to also as a main valuer have to make and satisfy that the kind of assumptions which the other expert has used are reasonable or not. It is a gray area in my view, which is not very clear that what is expected from the main valuer, what extent one has to go. But a clear reading of the report by the other issued by the other expert, and making some broad inquiries. Nowadays, with the help of internet, you have lots of facility available to find out some factual aspect about a particular area, about a particular machinery. At least you can satisfy yourself that it is not something which is out of range. We are yet to see any regulatory interference. I would not use the word interference, a regulatory guidance on this regard, that what is really expected from us as a valuer. But I think again the word used, that you have to be diligent. So we have to make sure that we have not just blindly accepted what is presented to you. If you have any conflict of interest, say your firm has done some tax work for this company 2 years back, And if you feel that it is material in nature, you must disclose that interest, so that at least reader will know that yes, there was some connection with this company by the valuer. If you have no connection, you have not done any work, you just write we have no connection and there was no conflict of interest which we want to disclose. The next bullet is very important. It covers the date of appointment of the valuer, the valuation date, and finally the draft report date. Now, let me just put some examples in the dates because you will be able to appreciate this. Say I am appointed on 1st of May. So my date of appointment will be 1st of May 2024. However, the requirement by the user is that valuation, please do it as of 31st March. Year ended 31st March, he wants to do the valuation because of some regulatory requirement or his own needs. So valuation date will be 31st March. I am issuing the report on 13th of June. So the date of the report will be 13th of June. So appointment in May 2024, report being issued on in June 2024, valuation date being March 2020. Again, in many times it happens that the date of valuation and date of report could converge with each other. But generally, there is a date of appointment and report date. There is a clear indication of the, that sufficient time was given to the valuer. And I'll tell you from one of the regulatory inquiries I have gone through, I was asked this question that when were you appointed? Say I was appointed in February 2010 and I have issued report on 5th of March 2010. The regulator wanted to know, is that sufficient? Is it a normal timeline of 15 days, which generally you take for doing the valuation, or is it a very short timeline? So first question asked by the regulator at that time was, 15 दिन में ये valuation कैसे किया आपने इतना बड़ा company? So that's how it starts. But then you can say that how the data room was given to you, how the data flow was happened, all those email exchanges which may have taken place, or the physical meetings which you may have taken place. Based on that, if you are able to demonstrate that for such company with availability of data, 15 days was a sufficient time, at least then that question will go away from your this thing. But that's why mentioning this date is very important. One very common question being asked by a regulator is that what happens typically when you get the representation letter signed by the client, management representation letter for summarizing all the data provided to you. Generally, it is just a day of the report or just a day prior to the report, because you will summarize all the points over last 1 month which you have collected and put it into a paper. Many times you summarize it and give it to client that these are the things I want a representation. So generally it is dated just either on the valuation date and maybe earlier day if it is made available to you. So one of the questions being asked by regulator is that if this data and the explanation was given to you on 15th of January, how have you issued report on 16th of January, just in a day? But then you have to explain the whole process. And that's why valuation process, unless it is known, nobody will be able to appreciate that, this whole process of 1 month, you have just summarized into the entire representation letter, and then you have just taken for the record purpose the signature on the last date. But otherwise, not that you have received on 15 January and you have issued the report on 16 January. That upgraded knowledge has to be given whenever questions are being asked. Now also you are required to comment whether you have carried out any inspection or investigation in respect of the in the valuation which you have carried out. Now, when you are doing a valuation of a plant and machinery, land and building, or any other physical asset, it is expected that you also inspect the asset and also look at the conditions and other things. For financial valuation, maybe that is not required or not warranted, but many a times these questions we need to ask that did you visit the factory when a regulator wants to know, and you have to either say yes or no. So factual aspect you have to keep very readily available in the file. And what are the different sources of information you have relied upon. The next portion of content of the report will involve what procedure you have adopted in carrying out the valuation and valuation standards which you have followed. Now we have discussed the valuation standard, but let me come to the procedure. Now here what is expected is that you define all the approaches and start discarding the methods within those approaches which you have not used and give a reasoning for that. And finally conclude that based on the above discussion, we would like to confirm that we have used following two methods for carrying out the valuation. So the reader will know that you have attempted all the valuation methods which were relevant for the exercise, but for whatever reason and justification, you have not used out of that, say, 4 methods, and another 2 only you have used. Say total methods which you have examined is 6. You have used only 2, and your justification of not taking up those 4, then mention that. That's what is expected, that what procedure in following this entire thing you have followed. Valuation methodologies which you have used, I just explained. Are there any restrictions on the use of the report? Now, as I mentioned, when I have done the valuation for a merger, if somebody starts using this for funding, you have to mention and very clearly tell that reader that this report is not for raising any funds or starting a negotiation for that, because my report was issued only for merger swap ratio. In good old days, before this entire exercise came into place, we were not even giving the valuation workings when we were doing merger valuation. We were just giving, finally, my report ended with only the swap ratio. I remember in a very clear way, in one of the matters of merger valuation, in the court, the one of the shareholders got up and said that the only 3 numbers which this valuer has given in the report is the date of the report, the paragraph numbers of the report, and finally in the swap ratio he has given some number. I don't have any workings in it. And that's where it is one of the Bombay High Court celebrated judgment, where it says that valuation, when the companies have engaged a totally independent valuer, you don't need to have a valuation workings attached to it, because it contains a lot of confidential data about future of this company, new product pipelines which companies has. So it's not necessary. Only if the regulator wants it, it will ask for those calculations. But if it is made public, the competitor will use it to its advantage. So in good old days, maybe prior to 90s, or maybe just even prior to 2005, valuers were not attaching any workings or even a summary of workings for merger valuations. Things have slightly changed because of regulatory, background. But otherwise, in good old days, there was no detailing which was being shared. Yes, valuers used to keep that in the file so that any regulator wanting to know those workings in a condensed form or the detailed form were shared. But it was not made, because you will appreciate that merger reports were filed in the High Court and it became a public document. Today, all the merger reports or demerger reports are available on the stock exchange websites. So lots of information which are confidential in nature, technically, if the entire workings are made public, may be misused by competitors. So there is always a fine balance being reached by the valuer, that what is required to be disclosed and what is not required to be disclosed. There are attempts where some more detailing is asked by the regulators before approving such restructuring, and those are generally supplied by the valuers. Many times if they are not very sensitive, they are also publicized in the websites of the regulators. Otherwise, it is kept as a confidential filing. But it's not the same old days where only the conclusions were being printed on the valuation reports. What are the major factors that were taken into account during valuation? And this is the segment under which you will write about surplus assets, contingent liabilities. Are there any customer claims which are pending? You have made any adjustment? All the big ticket items which has affected your conclusion will generally feature into this, which were the factors which affected the valuation. Again, there is no point writing smaller aspects, but if there are big ticket items like ESOPs, impact of ESOPs, or impact of any other convertible instruments, if you have given in the exercise, you must mention that. Then comes the conclusion in the valuation. Now, depending on the purpose for which you are being called upon, you may either give an absolute value. You say, value, in my opinion, the fair value of shares of so-and-so company is rupees 235.50 per share. That is the absolute value. There are cases where the user do not want an absolute value, but he says, okay, give me a broad range, because this report I am taking from you only for me to start negotiating with a potential buyer or a seller. So then in that case, the valuer may say, in my view, the fair value range of shares of this company is anywhere between 225 to 250%. So depending on the final expectation, or as Durgesh ji mentioned, that what is expected from the valuer, the scope, your conclusion paragraph may change. Now, one point I want to very clearly, guide the listeners, that if you want to draw the attention of the reader about a very sensitive item, my suggestion is that also at the cost of repetition, draw the attention of the reader to that paragraph, so that you say, we draw the attention of the reader. Paragraph number 5.2 regarding contingent liabilities, and the assumptions made by the valuer in this regard, and based on this, the fair value opinion as far as this particular shares are concerned is so and so. So reader will know that, because many times, with due respect, now what is happening, people are just using or reading only conclusion paragraphs. They are not reading those first 10 pages, 15 pages, because they feel it's all standard, I don't need to read. So they read only conclusion paragraphs. So if you really want to stress a particular point, because that has impacted the valuation substantially, say for example, in a calculation, I have used a surplus asset valuation of 100 crores, and because of that surplus asset adjustment, value per share is doubling as compared to the normal business valuation. But because it gets added surplus asset valuation, the value becomes double. Now, if that's a substantial number, you want to draw double attention of the, although you may have written in the factors affecting the valuation, you may want to write again a reference of that paragraph about surplus asset in the conclusion paragraph also. So the reader will know business value is 100 rupees per share. But if I do the surplus adjustment, it is becoming 200 per share. So when he is using that report, he will keep that in mind. Now, valuation workings, I put question mark because I wanted you to understand. In some reports, you have a detailed working attached, because you are entirely, it's a confidential report only given to the management for some specific inside, consumption. If it is for outside purpose where public at large also will look at it, many times a condensed report, condensed workings are attached, so that some of the very confidential information about product pipelines or any large legal claims are not taken into very specific disclosure points. Now comes the next point, which is very relevant, is caveats and disclaimers which may use. And now on this aspect, regulators are very particular that what all, they don't want you to just disclaim everything and anything under the sun and say, I have not seen this, so please read the report accordingly. They want you to also apply your mind and also use the caveats which are really, really relevant, and not write everything under the sun that, I have not checked this, I have not checked projections, whatever I have been given, I have just processed them. So it should not give an impression that you have just done some Excel calculation. That's where now regulators are closely looking at it, and maybe Sarika ji can confirm to us. I think there is a joint panel which is also being working on what should be the caveats and limitations which can be there or which may not be put. So I believe we may have some kind of guidance. I think guidance is already there, but further refinement of it being also attempted. Some of the caveats which generally are used is restriction on use of report, which we have discussed. What are the responsibility of the registered valuer? Accuracy of information. Now, many times you are given a particular information about, say for example, surplus assets. What is the area of the land which is surplus in nature? What is the details of it? Is there any construction on it? Now, if you have not visited the site and all that, so you then don't go beyond the point. Here you are not doing an investigation study. So many times we write in the caveats that the data which was provided to us, yes, we have done a broad inquiry, but we have not done a verification like an auditor or any other investigator in this regard. About achievability of forecast results, definitely we say that these are ultimately a future forecast. We don't give a assurance that these results will sail through. But at the same time, we have done a reasonability check. As I gave you an example in the start, that raw material consumption ratio, if there are any material changes to the assumption, you definitely do inquiries. In fact, in the entire exercise of valuation, if say 100 hours goes, I would feel 50 hours will go into the projections related discussion. Balance other time is used for all other discussions. So you can imagine the importance of forecast, which nowadays even valuers have started, because they are being questioned. So once the valuers are also being questioned, they also become more vigilant about the assumptions, and if they don't agree, either they want the companies to get it changed, or they appropriately increase the discount rate to capture that higher risk of achieving the projection. So nowadays, this forecast results, what is given to you is not just blindly taken. I'm not saying earlier it was not being reviewed, but the intensity with which now the projections are being reviewed are maybe a little far better as compared to maybe what was done 2-3 decades back. So that is another important point. If there are any events which have taken place post the valuation date, say for example, the example I gave you, 31st March was the valuation date, and the April there was a fire in the plant. Now your valuation date was 31st March. Will you be able to say that, okay, my valuation date being 31st March, I will not even write about this? You must draw the attention of the reader that, and if it is brought to your notice, if it is something which is not brought to your notice, in fact, you take a positive consent confirmation from the management that there are no events which have taken place which has either a higher or lower impact on the profitability or operations of the company. But suppose this kind of events which have taken place, like fire or strike, you may mention the impact of which you have taken or not taken in the valuation. Of course, no responsibility of actual price at the future date we take. Reliance on the representation of the owners or clients, their management, and their third party. Now, on the representation letter, I want to just mention in fact, in the past where I had some issue that sometimes a representation letter is signed by, say, Sujal Shah. Now, whether Sujal Shah is authorized to sign by the company, he may be working at the 5th level in the organization. CFO either will not even know what is being signed by him and given to you. So generally nowadays we insist that whoever has signed this representation letter has the authority from the board or from the managing director to sign this representation letter. You take a positive consent mention of that in the representation letter. In the past, there were some instances where somebody was signing the representation letter. Upon the regulatory inquiry, it was noticed that that person was not even given any authority by the higher in the organization structure, either by board of directors or audit committee, to even give such a representation without their knowledge. So one has to be now more clear and little more careful. No procedure performed to corroborate the information taken from reliable external sources. Now, many times valuers use the data from the readily available softwares, which could be Bloomberg or Capitaline or anything. Now, generally, you make a statement that you have picked up that data from this source when you write. You have not gone further and checked those correctness of those parameters which are given by those external sources. You don't confirm that this is in compliance with the laws. Whether they are running with the factory with all the environmental clearances and all that is something which is not our subject, nor it is expected from you. So generally, you clarify that. Multiple factors which we have discussed. Future services, including but not limited to testimony or attendance. Now, many times valuer also write in their caveats that we will beyond once we have issued the report, we will not appear as a witness in the any forum. Now, why people write that? It is seen that many times we know valuation is the easy target to challenge. So if suppose two brothers are fighting and you have carried out a valuation and helped one of the brothers to get an indicative fair valuation done for his help to negotiate with his brother with whom he is having a differences of opinion. Now, many times that when the matter goes for arbitration or to the court, you are called upon as an expert witness. Now, some valuers have taken a view that once I have issued a report, which is a speaking report, either you accept the report or reject the report. I don't want to go through the entire exercise of being cross-examined. And friends, this entire exercise of cross-examination is also a task by itself, because you may have done the valuation 4 years back. You're not allowed to take any external help, and you are being questioned by, say, 5 people on the other side of the table. So it's an exercise by itself. As long as you know the subject and you have done your right job, nothing to be worried about. But sometimes it becomes intimidating, and you have to be a little careful because people will provoke you. There could be some kind of accusation being, remarks being passed. So you have to keep your calm. If you ultimately agree to be an expert witness, be sure about what work you have done and the kind of answers you give, because ultimately, the result of the whole fight may be dependent on the way you have carried out the valuation. So one has to be a little more careful. Some information, if it is not available on when you carried out the valuation, say for example, some tax litigation is going on and somehow you could not get the full details and you had to issue the report. You please write a disclaimer that this data about tax claim which is pending were not provided to us. So reader should know that I have not been able to opine, or I have not been able to capture the impact of such possible impact on the valuation of such litigation which is ongoing, because data is not available. So any restrictions or anything which you have not been able to get and you want to draw the attention of the reader, you must write in the limitation. Some of the caveats which are not being appreciated, which can't be used in the valuation report, are there on the screen. About the business plan, I think we have discussed. Physical verification for a item which is going for liquidation, say asset being going for liquidation. If you say that I have not physically verified, that is not being accepted. Market related data, giving disclaimer for the market related data employed, again, is nowadays not something which is readily acceptable, because they also want you to do your own research and your own calculations before you finally give any conclusion. If you have used only one approach, generally registered valuer has to give reasoning, which I told you in the earlier part, that why you have discarded a particular method and why you have used a particular method. You please give your reasoning. If you have used another expert's report, we have discussed that. And if you have used historical analysis, you clarify that you may not have done the audit, but at least you have done a broad inquiry to ensure that there is a some kind of a corrected this thing. Some other points, I wish I have some time, right? 5-10 minutes, Sarika ji, is okay? Yeah, I think it should be fine. Okay, a valuer shall disclose the valuation basis which are considered in accordance with ICAI valuation standard 2102, which wants you to write the valuation basis for arriving at the valuation. Valuation approaches and methods which we have discussed, reliance of work on the other valuer, this point also we have captured. When the valuation is being undertaken for a client and is used for the purpose of any transaction or otherwise by another specified party. Now, say many times you issue a report to a particular client. Now, many times acquirer says, okay, I want to use this report because I also have to get some regulatory approvals and I'm fine with your valuation report. You have to generally get into another kind of engagement documentation, keeping your client informed. Many times clients are fine with it, but at least they want to be informed that you are also, allowing the other side of the transaction also to use your report for regulatory purposes. So at least you give that reference and also make sure that because of that your independence is not impacted. For a purchase price allocation, and what is purchase price allocation? You acquire a business for say 100 rupees. Now, land and building, plant and machinery, you get say worth 40 rupees in this acquisition at a fair value. What is left is all intangibles, for example, after removing even net current assets. In that case, you have to allocate 60 rupees to various intangibles, which could include brand, patents, trademarks, licenses, customer contracts, all this, whatever you identify. So you have to then write about this breakup, that tangible assets were so and so, intangible asset was so and so, and balancing amount is a goodwill. If you issued a report for a specific purpose like Rule 11 UA or for FEMA, as we discussed, or say under a preferential issue guidelines of SEBI, you write about the formula which you have used or what is the requirement of the regulations, so that the reader will understand that this may not be a full fair value, but it is based on the regulation which you have worked out. In a merger and demerger report, your merger report will include the share swap ratio, which will mean that, say, again, if I can give you an example of, say, Park Davis merging with Pfizer. So for every 100 shares of Park Davis, you will get, say, 50 shares of Pfizer. Now, that is the way your report will conclude. So that's called a swap ratio. Whereas in case of a demerger, it's an entitlement ratio. What happens in a vanilla demerger is that you will continue to hold one share of the existing company. You will also get, based on the entitlement ratio, shares of the company in which the demerger takes place of a particular business undertaking. Now, again, just to give you an example, say cement division of Larsen and Tobro is demerged. So you will continue to hold your 100 shares in Larsen and Tobro, but as per the entitlement ratio of 1:1, you will get 100 shares of cement undertaking also. So in that case, it is called entitlement ratio rather than a swap ratio, because you are not swapping the shares there. You are being entitled because you are holding shares of Larsen and Tobro. Many times, if there is a holding company collapse, what happens if a listed company A Limited is a listed company and there is a holding company H Limited, which is holding the only asset it is holding is A Limited. In that case, it's a collapsing structure. In that case, your wordings of the report will just say you are just collapsing the structure and shares are issued to the shareholders of H Limited. Now, this is the format I was referring in the, now when you do a valuation report which is required to be filed with the approval of the stock exchanges and SEBI, they have asked you to give the report in the conclusion paragraph has to have this kind of format, where asset approach, what is the value per share, what is the weight you have given, income approach and market approach. And if you have not given any weightage to say asset approach, write there that refer note number one and explain below the table why you have not used asset approach and give that reason. Again, it is not expected from you that you use the same methodology or same weightages for both the companies, because one could be an NBFC, another could be a cement company. Again, giving an example, a very vague example, but I'm just saying that two totally unrelated companies may be merging with each other. Your methodology and weightages could be different for each one of them. Not necessarily that regulator is expecting you to use all the methods and they are expecting same weightages for each one of them. So that flexibility is available. And this you can also see in various stock exchange filings which are done for merger and demerger in the recent times. It's available on the stock exchange website. Very clearly, getting into the documentation, we have very, detailed discuss, some of the aspect of it. As I mentioned, documentation file will speak for itself for many years. So generally, you keep those data for 8 years period and retain it before you finally start discarding those data, because after that, generally it may not come up for any scrutiny. All the documentation like we do for assurance, we should also complete before we finally issue the report, because many times it happens that you will finish the report, you will say, I'll finish the documentation later on. That later on will never come because of the time schedule and the other pressing assignments. So insist that all the documentation, when you're doing the valuation, you also finish the documentation. What to keep, how to keep is generally left to the professionals to decide, but make sure that what you keep and what you retain meets for any regulatory inquiry at a later date, so that it is written in a form. It's not some handwriting which nobody can understand. Put it in a form, if required, keep a typed word file and keep explaining, giving the paragraphs and other things, so that whenever at a later date it is opened up, it can give a very clear picture of how it is being handled. I think most of the points in this, as I mentioned, either it can be physical form or electronic format. If it is electronic format, you keep the backups if required. And if it is a physical form, make sure that those godowns or wherever you keep the files are properly secured in terms of, the pest control treatments and other things. There are instances where people have lost the files because there was no proper care being, followed. So some of these reasons may not, make the regulators happy at a later date. So we have to take our own due care for retaining those documentation. I think, let me tell you about engagement letter and, some of the other aspects of management representation letter. Other points are okay, circulars and all that. I'm sure you all will, keep it. But in engagement letter, what all you will include? What exactly you are valuing? Why are you being called upon? What is the scope of work? What are the timelines? What are the limitations? What is your background? What will be the fees you will charge? If you're going to charge fees in installments, at the signing date, you will charge how much? All of that generally is part of the engagement letter. Now, again, on a lighter side, in good old days, we used to just write, this will be our fees and be done with it. Many times, in what instances used to start taking place later on, that they take the workings, they take the draft report, but never ask you to issue the report, and it remains like that. And that means your trigger point for raising the bill itself will not come, because on issue of final report only then your bills are triggered. So nowadays, valuers have also become smart. They take some amount for the signing at the time of signing the engagement letter, some amount at the sharing the draft report if required, and then finally on issuance of final report, so that you don't get into the trap of spending the time and not getting any return out of it. So these are some engagement letter. You must include those relevant points. If you have any restrictions, you must mention in the engagement letter. In the management representation letter, generally all the information and discussion which takes place, you generally summarize. We have to only do this hard work of preparing it, because you are taking it for your saving your own skin. I have some instances in old days when we used to send the draft of the representation letter, and on the top we used to write to be printed on the letterhead of the company, and company used to not even remove that paragraph. They used to just print that on the letterhead and sign it. But I'm saying now, before you sign the report, make sure that the representation letter is in hand. There were instances, sometimes it happens that company also have busy executives, so they will say, okay, issue the report, I'll send the engagement letter, the representation letter later, at a later date, and it never comes. And after 3 years, you realize, management representation never came, and now regulators have called you. So before you close a file, you must make sure that all the relevant items are ticked. Then only you close the file and give it for final this thing. Last slide, I think, there are some of the, there was a peer review which is regularly being taken place in terms of all the registered valuers report which are being issued. And some of the common findings from review of those peer, review mechanism which has come out. Again, this is, a lot of painstaking work our RBO is doing to make sure that we do the work properly. Is somewhere date of appointment, valuation date were not properly mentioned, identity of the valuer were not mentioned, nature and sources of information from where the data is picked up was not mentioned. No clear indication of the approach is being used. Sometimes, approaches and methods are interchangeably used. Terms and conditions attached to the asset being valued are not mentioned. Preference shares, if you are valuing, that proper terms have to be mentioned, because readers should know that what are the terms attached to the which standards of valuation you have used. Scope of work analysis 201, standard 201 tells you to, elaborate on scope of work analysis, evaluation. That many times it is missing. If you have done for a specific regulation, that also at times it was noticed that it is not mentioned. Whether it is a going concern valuation or a fair valuation, many times it is not mentioned. If you selected only cost approach, why it was selected like that, that reasoning was not mentioned. So some of these points now we have to be very careful about. Some of the orders which IBBI has passed against valuer, what were the points which triggered those orders? The procedure adopted in carrying out the valuation standards and major factors that were taken into account were not mentioned. In one of the report, they said contribution of each partner was not mentioned. When I say contribution, suppose it's a partnership firm and there are 5 partners. What was the financial contribution of each of the partners is required to be mentioned. And in some cases, valuation standard or valuation approach used by the valuer was not specified. In such cases, IBBI has gone ahead and taken some kind of action. So we have to be now careful. Well, friends, I hope I have not exceeded my time, but sorry if I have done that. And thank you so much. I'll stop the presentation and leave it to the.
Back on time, 4 o'clock.
Okay, thank you, Sari.
I will thank you so much, sir. I will just take a minute for the resolve thing. Just 2 minutes I will take for the participants to go through. There's an international convention which was started last year by the institute, which is Resolve 2023. This event was conducted in Singapore, where all the stalwarts of insolvency came there. This year, what we have done is we have also included it with valuation thing. So now this Resolve 2024 is International Convention on Insolvency Resolution and Valuation. This is on 12th and 13th July 2024 and at Bharat Mandapam, ITPO, New Delhi. We have already got some confirmation where judiciary will be there, NCLT chairperson will be there, sitting NCLT members and NCLT members will be also there. Other than other speakers who have confirmed to us from some Singapore or US, some other speakers and all the stalwarts from India also will be addressing the sessions up. We are expecting around 500 participants in this convention, which will be both on insolvency and valuation. It is being organized in association with IBBI, Insolvency and Bankruptcy Board of India, ICI Registered Valuers Organization, as well as Indian Institute of Insolvency Professional of ICI, like triple IPI. We are doing it with sub-regulators of IPC as well as sub-regulator of valuation and the principal regulator who has the authority as on date, IBBI. So it will have lots of opportunities, lots of, it will give networking opportunity. It will give you, where you have clarity of thoughts and minds, you have the people there, speakers who can address your issues. ARCs are also attending, registered valuers, registered valuer entities, सबसे पहले chartered accountants, then insolvency professionals, insolvency professional entities, all have been invited. Then we have ARCs also we are inviting. Restructuring firms not only from India, but the hub of restructuring is Singapore. We are also targeting people from Singapore so that they come and address as well as share, discuss with you your concerns. Then we have attendees I have already briefed. These thematic issues are basically cross-border, debt restructuring, towards stressed asset to make a vibrant market. Then we have data availability and quality issues. Then we have any judgment, analysis of the judgments that have been issued beyond the objective of IBC basically. Then group insolvency, what are the issues? Digital assets, what are the challenges, and etc. So there are sponsorship slots also that you can see and we can discuss. I would request you all to kindly visit our website resolve.ici.org. Also on ICI website, on the homepage, we have launched its banner. The fees for the convention is 7,500 for the members up to 15 June, and 10,000 for the for non-chartered accountants. Kindly join this. It is a great initiative which has been taken, and last year it was a great success. As Gyanchand Mishra sir has already informed, 350 people attended this convention at Singapore physically. So in India, though, at least we can attend when we have so many opportunities here to learn and to also unveil. We can discuss, we can talk, we can have many things here. With this, I would request to mark your calendar and join for the event. Thank you so much. Thank you, Sujal sir, for taking this session in so depth. We have more than 1,000 participants at this time. 2 to 4 is a time when everyone is busy in their office. But still, participation by the people show that Sujal sir is, they wait for Sujal sir's session. And I'm very happy to announce Sujal sir is again coming on 21st June. We will circulate all the documents. he will be speaking with ICI RVO. We will circulate the information to all. With this, thank you so much, Sujal sir, for giving so clarity. And lastly, about the questions, some of the questions have come. I would request personally to Sujal sir to answer them, and then we can send mail to the participants who have shared their questions. So, thank you everyone. Thank you.